Hey guys, welcome back. And today I'm going to talk to you about something that's super important to me. That is my credit score. Now, credit is a fundamental a variable when it comes to getting any sort of financing or just to showcase that you're a good borrower. And I am absolutely in love with the credit system and especially in love with how to find ways to exploit it. Now, what I mean by exploit is when I was building businesses, I was very young. And because I was very young, I had to learn a lot about credit because I did not have age on my side. Most of the time, if you want to go to a bank, they want to see somebody who's been paying their debt off for 10 years. And if you're 22 years old and you got a credit card 2 years ago, my parents were not savvy when it comes to credit cards, so they did not understand that I should have got a credit card. And I only got a credit card because I was lucky enough to go to the bank one day and they had me pre-approved. But the main concepts of the reason why credit's really, really good is it shows lenders that you're somebody who pays their bills. And that is very important when it comes to wanting to get a mortgage, get additional lines of credit, get business financing. And of course, all this stuff comes later down the road in business, but it's a fundamental variable that you can use to increase your business substantially sometimes. Just one way to think about it is, let's just say, for example, an opportunity comes and you have to get product a lot cheaper. If you don't have credit that you're able to utilize and you don't have the funds available to buy that discounted merchandise, you pretty much leave yourself in a position where you have no option at all. And you know your competitors and your other people in business are going to take advantage of that opportunity while you fail to. So pretty much the way I like to approach credit is there are four fundamental parts of credit, and then there's also a secret fifth one that a lot of people don't care too much about, but it is pretty important. The first thing is credit history. Now, I beg you, please go check your credit history in your bank account. There's so many free apps that allow you to actually check out what your credit looks like. And apologies, my friends, I am still very sick, so if my voice is coming across pretty scratchy, that's why. But when you have your payment history on point, it shows the lender that you pay your bills, and the higher you, there's only one right answer to credit history, and that's 100%. 99% is pretty much a fail. Now, obviously, there are people who have had positions in their life when they were younger, for example, and they didn't understand how credit worked, that they did mess up this. So the 99% is pretty good. The reason why it's good in some cases is, let's just say that that was 15 years ago, but you paid off everything. Now the lender does see that you're smart enough, that you're mature about your debt, so you can also say it in that direction. Now, another good thing is credit only lasts on your account for up to 7 years. So if you missed a payment 7 years later, that credit payment miss does go away. However, that is not something you should consistently rely on. You want to make sure that you are paying your bills. The second big portion is credit utilization, which means if a lender gives you, let's just say, for example, $100,000, you may think, oh, the lender gave me $100,000. I can use all 100,000. You definitely should not. The reason why is kind of a tricky game. The lender wants to see that you're smart with your money, not stupid. For example, if you have $10,000 worth of credit cards and you have $10,000 worth of credit card debt, the lender sees that if anybody who gives you anything, you just waste it. And whether you waste it for a good reason or a bad reason, you look very risky. Because what happens if you can't pay that $10,000 back? And no lender wants to think that you're not going to pay off the debt. And if they see that you have a consistent habit to utilize all your credit to buy stuff that you can't afford, or to buy stuff again that you cannot afford, no one's going to lend to you. So make a really good position to have your credit utilization is under 30%. If you're doing that, you're golden. And in some rare scenarios, even having under 10% is even better. And I'll go over why in a little bit. Now, the third main thing, and this accounts for about 15% of your overall score, is your credit history. Now, obviously, this is the stuff that a lot of young people have a lot of trouble with, because if you haven't had debt before, how on earth are you supposed to show them that you're a responsible lender or a responsible borrower? And there's no real way around this. The way that I found out this is if you get enough different types of credit, you can make up for it. Because, for example, think of it like this: if you have one credit card a month, so you have one credit card, you get 12 statements in a year. Now, let's just say you had two credit cards. That means you get 24 statements in a year. Now, if you had six credit cards, you can see what I'm saying. The more different types of debt you have, the more statements, the more history you'll be able to make at a faster rate. Now, credit mix, which is like you can think of it. This is the kind of on the not so safe. This is kind of the stuff that people don't really worry about, but it is pretty substantial. Is lenders don't just want to see that you have $10,000 available of credit card debt. They also want to see that you're good at managing other types of debt as well, such as lines of credit, mortgages, car loans. All of these debts are different, and if you use it right, you can show the lender that you are very smart when it comes to any different types of lending. So having a credit card and having a car loan and having a mortgage, although you're going to try to obviously avoid the least interest you can get, and you're going to be smart with your decisions, but showing them that you have a record of paying off all these different types of loans and debts really does help you out in the long term. So I just want to get that across. Now, the main fourth thing that a lot of people contribute is new credit. So I call it like credit. I call it like etc. pretty much. So this is when you're opening bank accounts, when you're opening credit card stuff that takes a look at your credit score. Because believe it or not, every time somebody looks at your credit score is going to go down. Because people are like, oh, this guy's looking for borrowing. It's a very funny system we live in, but it does make sense. The reason why it does it is a lender wants to know that you're not, every single month, you're not looking to go get a new credit card. And there are times where you can actually do that. But everybody wants to make sure that you're being responsible, because at the end of the day, they're in a business of making money, and they do not make money if they lose money on you. So pretty much the way you want to approach stuff like this is, although in the short term you do get a hit to your credit, long term you get a lot of benefits. So for example, if you open up a new credit card today, you might lose 20-30 points in your credit score. However, because now you have access to 10 grand worth of credit, and let's just say you had 10 grand worth of credit before, now that means you all of a sudden give yourself 10 grand worth of more credit to lower down your utilization. So if you were spending $5,000 on a $10,000 limit, you were spending 50%. But all of a sudden, with your new $10,000 credit card, now you're only using 25%, which actually in the long term will increase your credit score. So this is stuff to keep in mind. This is how you have to play around with your credit, and you have to become very financially literate. And I really do think that when you start to make a habit of looking at your credit score very often, and again, your credit score doesn't go down when you look at it. It's called a soft inquiry, and so you can look at it as many times as you want. But this is what happens if you make a consistent habit to consistently view it and see how you can make your credit even better. It's only going to help you in the long term, because one day when you do need capital to grow your great business, you will have the ability to do so because you're smart enough to have a very long history of showing that you are very good with money. So yeah, guys, just wanted to make that quick wrap up. I will go into a lot more depth about each one of this and actually how to use credit card points and all that stuff, but I just want to give you the basics today. Thank you so much for listening. Please subscribe. I'm really trying to focus in on trying to make really good content, and if you guys could help me out, that'd be awesome. I appreciate you guys, and see you guys tomorrow.